Hello and welcome to part 3 of this WD Gann's Gold series. In this video, I'm going to tackle form reading. And if you're interested in making money as a trader, then you are studying the right man, WD Gann, and the right topic, which is form reading. If you go through Gann's books and courses, you'll find form reading or some kind of variation of form reading and swing trading and these sorts of things in just about every book of Gann's, and it will be very close to the front of the book. Gann knew how important form reading skills are, and that's why he went to great lengths to teach them to all of his students. I've done a lot of work on Gann's time cycles. That's Gann's planetary systems and his law of vibration or numbers systems. And a lot of those cycle dates that are given come out really well in the market. But if you want to trade those turns, even the ones that come in really well, you need to have the ability to form read a market so that you know when and where to get into the market. And that's for the good trades. That's for the dates that work and they're clean and they're clear. When a market is choppy and messy, I'd argue that's when you need form reading most of all, because it's going to keep you safe. It's going to keep you out of a lot of losing trades, and it's going to protect your trading capital. For many years as a trader, I was making money, but I felt really inferior to these guys who were out there who were expert astrologers and different things like that. But what I found out later was that so many of these people weren't actually making money because they had an idea when the turns were coming in, but they had no system for trading them and they had no skills to be able to form read the market. And I'm not joking about that. I'm not bragging. It's just the truth. This form reading is a crucial part of Gann analysis. And I look across my bookshelf. You can see the picture in the background there that we've been running for this Gann's Gold series. These are just my Gann books, let alone all my other trading books and courses that I have on my shelves. But in Gann's books and courses, form reading is in nearly all of them. In just about every other book on Gann, written of course by people who aren't Gann, form reading barely rates a mention, if at all. But it's the most crucial lesson, so buckle up. This video will probably go for 30 to 40 minutes or so, but as it goes along, I've hidden certain techniques in various parts, so there is gold here in this video if you're prepared to sit down and watch it and work for it. If you're new to the channel, welcome. My name is Aussie Dollar Man, and this channel is dedicated to the works and teachings of the great WD Gann. At the top of the channel, you'll find some videos that will help you to get started and show you a little bit about what Gann's teachings and techniques can do for your trading. And if you do find value in this video, all that I would ask in return is that you click on the like button, leave a comment, and if you haven't done so, subscribe to the channel. It does help me to grow the channel and get Gann's teachings out to more people. And if you're feeling really grateful, click like on other people's comments as well. It just shows the YouTube algorithm that there is value in the video, and it will then recommend that video to more people. Now, if you've been following the series from the beginning, you'll know this is a photo taken of my collection of Gann's original books and courses, and you can find form reading in quite a number of them. But for the purposes of this video, I just want to direct you to this one here, How to Make Profits in Commodities. There are two versions of it, and I'll explain those in a moment. But section 2 of How to Make Profits in Commodities, in my opinion, is one of the best ones to tackle. It's very complete, it's very clear, and it's very concise. So first of all, why form reading? Why is form reading so important? As I mentioned earlier, sometimes market forecasts come in perfectly, but most times they are at least slightly out. And Gann had a term for this. He called it lost motion. And you can have lost motion in price, where the market runs a little bit above your forecast or a little bit below your forecast. And you can have lost motion in time as well, where the market comes in a day or two early. But because of this imperfection, we need to have these form reading skills to help us to understand the position of the market. Where are we on our different time frame charts? Are we weak? Are we strong? Is the trend up? Is the trend down? Has the trend changed yet? Is it about to change? What am I looking at? And in order to prepare yourself to handle those situations, because I can tell you, when you've got a forecast ready and the market approaches that date and the market starts moving up and down really quickly and everything's happening at a fast speed, you need to have a skill set to fall back on so that you don't jump into the market and force your way into a trade that's not there, or sit on the sidelines and let the market run off without you when the turn was already clearly in. Now, that's why form reading is so important. Next question is, what actually is form reading? Well, form reading is a collection of techniques, and it includes things like swing charts and trend determination. So being able to draw a swing chart, being able to determine the trend of the market, being able to determine the sections of the market and which section you're currently in. Gann spoke about markets moving in 3 to 4 sections, or impulse waves if you're an Elliott wave trader. In Elliott wave trading, they'll talk about 5 waves. So if you're in a bull market, you'll have a run up and a run down. That's wave 1, wave 2. And the next run up is wave 3. Then the pullback is wave 4. Then the third and final run up is wave 5. Gann spoke slightly differently about the market. He said that after 3 sections, watch for a definite indication of a change in trend. But if the market then continues and gives you the fourth section is almost always the end of the move. Now, he does also say, and you can read about this in How to Make Profits in Commodities, but he does say that in moves of short duration against the trend, it will only take 2 sections to unfold. And when I first started working with sections of the market, I thought this is a bit of a scam. Gann saying, well, it could be 3 sections, it could be 4 sections, it could be 2 sections. He's basically having a bet each way, and he's going to be right most of the time. But how do we know which one it's going to be? Well, it's by combining your form reading skills across multiple swing chart timeframes that you're able to make those decisions. They are mechanical decisions, but you have to put in the work and have the skills to be able to read the market and recognize what's happening as it's happening, and then be able to act accordingly to your trading plan. Gann also talks about resistance levels, and he talks about percentages of highs, lows, and ranges. He talks about double tops and double bottoms. So if a market reaches a double top, often that will mean that the trend is over and the market's about to start a move in the other direction. Or in this case, from a double top, it would be heading down, or from a double bottom, it would be heading up. And finally, there are things like market signals or signal bars in the market, where you might get a market that opens, runs a little bit higher, and then runs all the way down, closes on its low. That's a signal that the market is probably going to go down the next day. So this is just a few examples to get you started and to get you warmed up. If you want the complete lesson on form reading, as Gann taught it, I'd recommend reading section 2 of How to Make Profits in Commodities. Now, firstly, where do you get this book? I'd recommend that you get it from wdgann.com. That is Lambert Gann Publishing, as you can see down here on the bottom of the book on the right here. That's the 1951 version of the book. I don't get anything for recommending these. I have no affiliation with wdgann.com, but I bought all my original books and courses from there. As I said earlier in this series, you can actually find most, if not all, of Gann's books and courses online somewhere in PDF format, but A, it's not always the best quality, B, it's not always complete, and C, it's not always in the right number of pages. Now, before we move on, very quickly, you'll note that there are 2 versions of the book. The one on the left was the 1941 edition. The one on the right is the 1951 version. One difference you may notice is that the first book has 24 charts, whereas the second book has 32 charts. But the main difference here you'll note is that the 1951 revised up-to-date edition lists WD Gann as the sole author, whereas the 1941 version listed WD Gann and John L. Gann, his son. And if you read through the book, there's gushing praise of John. Gann writes about the sections that John wrote. There's a picture of John. And you can imagine, as I would imagine, being a father, that WD Gann would have been tickled pink to be working on this sort of stuff with his son. However, unfortunately, by 1951, there's been some sort of falling out. So which book do I recommend? Well, probably the 1951 edition would make sense, as Gann says it's up to date. But really, at the end of the day, you can read both and you can make up your mind which one you prefer. Now, form reading, looking at the 1951 edition, it's a 27-page chapter of a book. Now, Gann doesn't write fluff. He doesn't muck around. They are 27 chunky pages of very high quality lessons. So this is not a quick study. You're not just going to pick it up. You might not even finish it in one sitting. It's that dense. What you need to do is just take each concept slowly and investigate it on your market or on the markets that you trade and see what you think of it. So for example, Gann will talk about double tops and bottoms. Go and look for examples on your market on your different timeframes. He'll talk about ranges, resistance cards. Go and apply them to your market and see what you notice about them. Just take one technique, study it on a range of timeframes over multiple years, to test it thoroughly so that you know, does the technique work? Is it worthwhile? And is it something that I want to include in my own trading? Let's look at an example now on the Australian dollar, US dollar. I saw this chart today. I've been planning to do this video for a little while. Life has been getting in the way, and I thought this is a great example because at first glance, it's a trade setup that looks really, really good with form reading. So what I did was I put it together and we will watch it unfold. I'm recording this video several hours after the trade began because I've been putting together slides and just tidying things up, and I've been taking screenshots bit by bit to show you the trade unfolding. And I'm going to walk you through step by step how to interpret, using Gann's lessons, how to interpret each step of the market and rate the strength and weakness of the trade so that you can make your own conclusions and your own trading decisions based on your trading plan and based on your research and investigation of the techniques. Now, obviously, I'm not going to explain every technique in full detail. As I said, there's 27 pages there. It's going to take you time to go through, and I could probably run a 3-day form reading course if I wanted to, which I don't. So it is going to take you time to get through there, but here's an example of a run up. This is a 4-minute chart, so a pretty small time frame, and you can see we had a run from a low down here up to a top and then double tops here on this market. So I'm just going to apply a few form reading skills to this market and have a look. Firstly, I note 3 sections in this market. We had a run up here from the low up to the high. Now that's happened in 2 swings there. At the time, you probably think that this is your first section up, and you may be right. You've got 1 and then 2 and then arguably maybe 3 and then 4 that way. Looking at the ranges though, you can see here 22.7 points. See, 22.7 is the size of this range. That's section 1. Next section up, 26.3 points. Pullback. Next section up into that top, 23.1 points. So what does that tell you? Number 1, you've got 3 sections and there's some harmony between the ranges there. Number 2, that third section is a contracting range compared to the second one. It only managed 23 points compared to 26 points last time. So perhaps the market is running out of steam. So paying attention to things like highs, lows, and the ranges between them is a key component of form reading. Now, with sections of the market, it is often and correctly said that they are easiest to determine in hindsight. As the market is unfolding, obviously there's a lot of emotion that comes into play. There's a lot of confusion that can come up, and it's not always easy. So you've got to build some rules around this. And that's why I say, don't just look at one example, look at lots of time frames and look at lots and lots of moves. Go back 2 or 3 years and spend a couple of days on your market. You can do 2 hours a night or something, but go through and have a look at the different moves. Say, okay, here's a weekly swing, for example. Break that down into its smaller sections. Have a look on the daily chart and the 4-hour chart, for example. I normally find that it's not just one time frame that will give you the section. So for example, this is a 4-minute chart that I'm looking at here, but these are not all 4-minute swings. That's not a 4-minute swing from the low to the high. It could be a 15-minute or a 1 hour or a 4-hour swing, for example. So that's why you've got to look at these on multiple time frames. And that's why form reading is part 3 of this series. Part 2 is wheels within wheels analysis. And that's why you need to study that first so that you can get comfortable with looking at the market on multiple timeframes to make your decision. So here's some early form reading. Now, if you've got 2 sections up and you've got 22 points, 26 points there, once that third section to the upside begins, you could run this range from here. You could say, well, I'll look for 22 or 26 points, and you've got 23 points up to this top over here. Now, it's only a couple of ticks out, not a bad forecast there. 3 ticks is not too bad from a trading perspective and from a form reader's perspective. If you were to look at this on a larger chart, like say a daily or a weekly chart, and you saw this kind of setup, you might see something like 227 points, 263 points, 231. You're still within about 20, 30 ticks there. It's still enough to swing trade in most cases. Now, after that third top, we had a pullback there. What does Gann say in the sections of the market lesson? I read it out to you earlier. Gann said, after 3 sections, look for a definite indication of a change in trend. What's a definite indication? Well, maybe an overbalance in price. So you've got a run down here that's roughly equal to this run down over here and to this run down over here. There's nothing unusual here. So from there, you might start thinking, oh, maybe the market's going to do a 4th section up. And that's a legitimate concern there. Okay, that's why you're not just going to use one technique to say, yes, the top is definitely in the market. There are other things that you will use, and I can't cover all of them here, but I'm going to give you a few more. Another thing that I would recommend doing is counting bars. Whatever time frame you're on, is count the price bars. If you're on a 4-minute chart, count the 4-minute bars. If you're on an hourly chart, count the hourly bars. If you're on a daily chart, count the hourly bars. So I'm going to add those on now. And you can see this first run up was 95 bars, or 95 4-minute bars, which is 6 hours and 20 minutes. The second section up was 96 bars, or 6 hours and 24 minutes. So you've got basically equal price, slightly ahead on price, and equal time there. So there's some nice harmony there. Then for your third leg up, very close to double 95 bars, which is your original back here. Double 95 would be 190 bars. Here it's 182 bars. Now, Gann talks about 182 days of the year being an important time frame to watch. 182 days obviously is half of a year. Well, 182 bars is still half of 360. So these circle numbers are important no matter what time frame you're looking at them on. Now, as I said, the market ran down, didn't give us an overbalance in time or price, and started running back up. Then here, can you see we've got one, maybe a second section there, and then a third section into a failed double top here? Now, when double tops happen, you don't always know that it is going to be a double top. In this case, it was, but on that particular bar, you don't know for sure. Here, we opened, we had a strong bar, we ran up, we broke that top there and closed just below there. That's called a false break of that top. Again, some more form reading for you there. The false break is not specifically mentioned in this chapter, but Gann does allude to it in various parts of his courses. And the theory is, if it can't go up, if it can't break through that top there, well, it's probably going to go down in the opposite direction. But around double tops, you don't always know for sure. That's where you want to bring in some other techniques as well. And here's one that I really like. After you've had a run up in the market and then a decent pullback, sometimes it's the first run up, sometimes it's the larger run up like this, but run a Gann fan in TradingView. And what that does, it actually doesn't run Gann angles the way Gann intended them to be run. But what it does is it runs it up as the pitch of the market. So this is running up at a certain number of points per bar. And then it gives you divisions of that pitch. So you've got 1/2 or a half, a third. See the 1/3 line called the next top there, the quarter line. And then the 1/8, that's where the double top came in. It poked through the original top, poked through the 1/8, and then came back below it. See the market found support on the 1/8 all the way up there, the 1/8 pitch there. And then it will come below there, and then it will make a final top underneath that. It's like a kiss of death, and the market drops away from there. Now, I'm not saying that this is a sure trade or a cinch, as Gann called it, but you can see you've got the sections of the market work. You've got a failed fourth section ending in a double top there. You've got a false break above the double top, and you're touching that 1/8 line. That's not bad. You can also divide up this range here. And when you do that using a range as resistance card, you can actually see that the market respected these range percentages on the way up. So these lines divide this range into 1/8. On the way up, after we had a little run up here, the market sat on that 1/8 line. It ran up to the 3/8. So where it finished here, that was 3/8 of the total distance it was going to travel, which begs the question, does the market know where it's going? I think it does. You've got a top here just underneath the 50% and then a bottom that just pierces that 50% and comes above there. But the key one for me is this one here, this strong spike low banging into that 50% milestone there. It's not in this chapter, but in the US steel lesson that Gann gives, he says that tops and bottoms in the market become halfway points. So if you're going from a low up to a high, this low here is a halfway point. Now, in isolation, you don't know just using this ranges card that the market is going to go up there. You could raise this higher and the 50% level might touch another low. And you might say, oh, look, there you go. It's touching that low. We're going to the higher point there. It's not enough to use this in isolation, but this is confirmation on top of our 3 sections, on top of our 1/8 line there. And that's how you build together what I call a completion signal in the market, or a pattern of completion. If you're looking to go short, and I wasn't particularly looking to go short, but as I said, it's just an easy example. There's some more I want to talk to you about this. But if you're looking to go short in the market, you have to build a case for it. And if the market is running up, you need to build a case that says this up move is finished, it's completed. Now, what can you use for that? Well, a double top means it might be completed. Your sections of the market might mean that it's completed. I'd be happier if it was 4 clean sections. So we had those 22, 26, 23 sections up. And then if you got another 22 or 26 into that top there, that would be 4 sections. I'd be a lot happier with that. But after 3 and then a double top, that's not looking too bad either. You've got some harmony there. You've got the angle as well. So again, that phrase is a handy one to think of, completion. What evidence do I have that this move is completed or has completed? From there, it's time for a smart trade. Now, if you've been following the channel for a while, you will have heard me use the term smart trade. I will talk more about that in future. But a smart trade, basically, if you haven't heard of it, that's my invention. An S stands for a small risk trade on entry. I don't like entering trades where the risk in terms of points is large, because the market's only got a finite number of points that it can move. Let's say it's going to move 200 points. If I'm risking 50 points, well, there's only 150 points left for me on the trade. You'll see how that works in a moment. But if I can get in with a 10-point risk or a 5-point risk, there's a large amount of points left for me. So my reward to risk ratio, my reward is the number of points that I can make, and my risk is the number of points I'm risking if I'm wrong. The reward to risk ratio can be very, very high. So it's time for a small risk entry. For me, the 2 key letters here are the S and the M. S is for small risk entry. M is for move stop to break even. The sooner I can get in with a small risk entry and then move my stop to break even, it means that if the market runs off, it's running off with me in there. And if I'm wrong on the trade, I've got my stop loss at break even, so I'm not going to lose any money. Okay, so time for a smart trade. In this case, I'm showing you an example on a 4-minute chart. I wouldn't always use a 4-minute chart, but we'll look at that because that's what we're on. But on that 4-minute chart, a 4-minute swing chart entry after the double top has presented itself would give you a risk of 6 points on the trade. Now, the Australian dollar might move anywhere from 60 to 100 points in any given day. If you're risking only 6 points, and if this is a top, and if it's correct, if the market moves 60 points in your favor, you've just made a 10-to-1 reward to risk ratio on your trade. Think about that for a moment. Let's say that you're trading a $100,000 position. So you're trading at $10 per point. You're risking 6 points. So you're risking $60 US, but you're making 60 points, which is $600 US. You do that once a day, $600 a day, it's $3,000 a week US, $150,000 a year, give or take. Convert that to Australian dollars, and you're looking at somewhere around $220,000, $230,000, depending what the exchange rate is. That's not a bad yearly income for doing one thing like this once a day. Now, setups like this don't always appear every single day. Some days are just awful and messy for trading and nothing happens. But on the flip side, you also get days where the market runs a lot further than 60 or 100 points. You can really compound into a smart trade. That's the A, by the way, accumulating additional positions with the market's money. But anyway, let's not get too far ahead of ourselves. Let's look at a potential small risk entry here. There's the double top. The second top comes in at 66.76.6. You've got a low down here. So you've got the run up there. Then you've got an inside bar after that where it's comfortably below this. So we're looking for the swing chart to turn down. That's one possible entry into the market. The low of this inside bar, 66.72.8, and the stop would probably go at 66.77.6. So 71.8, you're looking about 6 points of risk. Once the market swings down there, you're in, your stop loss is up there, and you let the trade unfold and see what happens. So fast forward a little bit, and by the time I started recording this, see now I'm out of replay mode. Back here, I was in replay mode where I was just setting up the background for this trade. Now, every slide that you're looking at here, I was recording live as this trade unfolded. And I'm just going to walk you through when I see interesting things here. So first of all, we had a steep run down and a pullback. Everything looks good at that point. The market continues down there, but it didn't repeat this range down here. Now, in those cases, you normally see one of two things. It's either the market couldn't repeat its range down there, so this down move is finished and we're going higher, or you just run up, you get a little double top there, poking through a little bit there, just to kick everybody out. So I don't know if that's the market doing this or the big hedge funds doing it during the Australian or the Asian session where there's a little bit less volume in the FX markets than at other times. But for whatever reason, it's not uncommon. That's why I like to target a top. Get in at the top, put the stop loss above the top, let the trade unfold, let it pull these tricks on other traders, and then once it's done that, move your stop loss down to break even, and then let the trade run and do whatever it wants to do, and make your money or get your break even. And that's your two outcomes on the trade. But here, it's starting to look like the trade is going to fail. Now, for me, if I'm going to take a trade, I have to believe in that trade. So I'm happy to be in the trade because I know in the long run that I have a decent success rate as a trader, and more importantly, that I have a great reward to risk ratio when I'm right on the trades. Do you realize if you can get a 10-to-1 reward to risk ratio on the trade? So if you get a 6-point risk like this, if you can make 60 points, that's a 10-to-1. If you can make a 10-to-1 on a trade and you are right one time out of 10, you're wrong the other 9 times, you will still be profitable as a trader because you're risking 1 unit of risk 9 times. So 9 times 1 is 9. And then on your winning trade, you're making 10 units of risk. So 10 minus 9 is 1. You're still ahead after 9 out of 10 losing trades. And if you learn form reading and if you combine it on a series of charts and a series of swing chart timeframes, and you wait for the overwhelming evidence that a trade is setting up, you're going to do a lot better than 1 out of 10 with Gann's methods, I'll tell you that. It depends on you and the amount of work that you're prepared to put into this and the time and the price investment that you're prepared to put into all this stuff and learning how to trade, but you can do a whole lot better than 1 out of 10. Now, you don't know when you take the trade if it's going to be the one that drops like a stone or if it's going to run up and stop you out there. You can have an idea based on Gann's time cycles from Tunnel Through the Air, which I know some of you have done a lot of work on, and some of you have working in your trading at the moment. But you don't always know, especially on the very little picture like this. The rule that I've given you there, when the market runs down and then it fails to repeat itself, be on guard. Now, in this case, you're about to see the market has moved down a little bit further, but be on guard for an opportunity to move your stop to break even. So it's run up and then it's given you a little lower top there and then started to head down. To me, that's a place that you can think about going to break even. You'll also find on the way down there, again, using that pitch of the market. See, we use the pitch of the market down here. Now, here, you could run it to this low, or you could run it to this low. I normally wait and see which one gives me a hit, which one starts working. Here, straight away, we ran to that 1x3. Then we ran down, and then we came up to the 1x8. For me, the 1x8 is kind of like a point of no return. If the market busts up through that 1x8, then almost always it's going to take out that top there. Here, it did poke its nose through slightly and then came and closed below there and then headed back down. So at this point, I can move my stop loss down to this break of that 1x8, and that's nearly a break-even trade. Or, because it's a little bit dodgy here, I can just say, you know what? There's plenty of other trades. There'll be another trade, maybe later today, maybe later this week, maybe later this month, but there's always another trade. This trade, not too sure about it, and there's more to be not sure about this, by the way, which I'll talk about later in the video, so stick around. But if I'm not sure, what's wrong with moving the stop to break even? If the market just kicks you out and runs off without you, so what? You're out for a break even, you haven't lost anything. But it just takes all of your psychological challenges out of the trade, or 99% of them out of the trade. There's no fear of being whiplashed out. In the FX markets, there's plenty of volume, so it's not going to gap during the week, gap against you during the week, 99% of the time. I have seen it once or twice during big announcements, but you can just avoid those times. But generally speaking, you're now safe in the trade. You just go about your life. You go and have lunch, you go out, play a round of golf, watch a movie, take your kids to the park, whatever you want to do. Now, if we flash forward a little bit, 4 minutes after I took that last slide, see, here we are. It's actually in that bar there, bang, like minutes later, bang, the market shoots down. Okay, that now says to me, okay, it is going further down. So I'm happy to have my stop at break even there, because even if the market turns around and starts going up, it generally won't just go up in one straight line. And this line here, every 4 minutes, as another 4 minutes passes, that line goes lower and lower and lower. So by the time we get to about here, say another 20, 30 minutes later, the line is here. And if my stop is at break even, sitting above there, the market's got to go through that line to kick me out for break even. And that's where you want to be in a trade. You want to be ideally in a place where you're in your initial position and you've got your stop loss at break even, or maybe even locking in some profit, and you've got strong technical lines or price milestones between your stop loss and the market. So to stop you out, the market's got to smash through that strong support, which means if it does so and takes your stop loss, then the move is probably over anyway. So you're not going to just get whipsawed out and the market runs off without you. So again, that's where you want to be. Stop loss, entry plus commission, protected behind something like this. Now, these angles will work differently on different markets. That's up to you to go in and have a bit of a play with them, with your ranges resistance card, and with the different tools that Gann teaches you in that form reading chapter. Let's move on to the next slide now. After that steep run down, the market didn't really go anywhere. It's just progressed a little bit further down there. Now, that's taken 2, 4, 6, 8, 10. That's 11 bars. That's about 44 minutes have passed there. I had a nice steak sandwich for lunch in that time there. I've come back, not much doing there. So you go on and you do something else. Don't fall into the trap of sitting there and watching the market all the time. I wasn't going to do this video today, but I saw this opportunity. And again, I've got more to say about it. So stick around, but I saw this opportunity and I thought, okay, we'll have a look at this because it's a really good learning opportunity for form reading. Fast forward a little bit further, we've come down, but it's not really taking off. It's broken the last low there, broken a low over there. It's not really taking off. Fast forward a little bit there, we've now put in a couple of little higher bottoms there, just a little bit of doubt. But again, the stop loss up here at break even, 6672 or thereabouts. So the market, to stop me out, has to run up and break through that 1x8 to get me. Now, as you can see, we've had strong double tops here. There's not much going on here. It's really struggling to go down. And that begs the question, why is this move so messy? Well, as a general rule, a messy move usually tells you that you're trading against the trend. So you're trading, in this case, with the market struggling to go down, you're possibly trading against a bigger picture uptrend. Now, you can still make money out of those moves, but they're the moves that are more likely to be choppy and sideways and to chop you in and out and to just take your stop loss and run off without you, that sort of thing there. So you got to be very careful about jumping in to those kind of moves. And that's why form reading is best used in conjunction with wheels within wheels. And that's why you really should learn that first. Now, there's the video, Gann's Gold Part 2, Wheels Within Wheels. It's only a 20-minute video, but it will explain that wheels within wheels concept for you and expand your knowledge on that. Wheels within wheels is basically looking at multiple time frames of the same market side by side. So here Gann's got a yearly, monthly, weekly, daily. It's common these days for me to have monthly, weekly, daily, and then say a 4-hour chart. So with that in mind, let's now look at a bigger picture time frame chart. I've shown you a 4-minute setup with the market struggling to go down. Let's have a look at the daily chart. Well, the daily chart has been very, very strong since this early September period. The market's basically just been running up for the last couple of weeks. So we're in a strong uptrend on the daily chart. That's starting to explain to us now, it really makes sense, why the market is struggling to go down. So at this point, what I expect is that at some point, this downward move will fail and the uptrend will resume. Maybe it will come back, it will pull back to one of the old tops, maybe this top over here. But at the moment, it is struggling to go down. Let's look at those charts side by side now and with a little bit more detail. You've got a slightly bigger picture swing here. Let's just ignore this little outside bar for a moment. You've got this bigger picture swing here, and the market has run 133% of that first section up there. So it's putting in expanding ranges to the upside, and it's looking really strong. So statistically speaking, it's more likely to have a pullback and then get set for a low somewhere and then have another run up than it is to just plummet from this point. And that's backed up by looking at the left side of the screen here, which is the weekly chart. You can see out of this low here, that's all one weekly upswing, one big expanding weekly upswing. So the Aussie dollar is showing a fair bit of strength at the moment. So given the weekly and the daily big picture strength, what do? Do we jump out of the 4-minute trade? Well, first of all, you should look at all of your charts before making a trading decision. But sometimes you can still pick that daily top, if that's a top, and the market can run down, and you can still make a 10, 20 to 1 reward to risk ratio trade, even out of a pretty sloppy move. So here, let's say you got in at 66.70 and the market runs down to 65.70. It's still a 100-point move there. And if you're in with a 6-point risk, that's a 15, 16 to 1 reward to risk ratio on the trade. And it can be done. But just keep in mind that if you're trading against the trend, you're not going to get these big runaway moves. Ideally, you'd want to look for that kind of setup at a low like this, where you can capture 200, 300, 400-point moves with that initial 5 or 10-point risk on entry. And that's how you get the really big reward to risk ratio trades. If you look at that pullback there, that was 77 points, so not a very big one there. You might target a 77 point, or sometimes it'll go 1.5 times that pullback after the second section up there, particularly if it's an expanding second section up there. So maybe we run down a little bit and then we have a third leg up there. I mentioned in the Forex form guide, which goes out on Sunday evenings, Sydney time, I mentioned that my next price target to the upside on the Aussie dollar is 6776, so 67.76 cents. So perhaps we get a bit of a pullback and then another leg up into that top there. So that brings me to this slide, trading in a nutshell. In a nutshell, just watch multiple time frames. Don't say, I trade the daily chart, so I'll just watch the daily chart. Be aware of what's going on multiple time frames. Look at your weekly and your daily and your 4-hour as a bare minimum, your WD4. Then apply form reading to all of your charts. Get a sense, is this market trending up? Is it trending down? Is that trend weak? Is that trend strong? Where are the potential price levels? Where are the breakout points, etc.? Do all of your form reading work to all of your charts before you make a decision to trade. And then know where you are on the major and minor cycles. Now, you're not all at that level yet, and that's fine. That's something to aspire to as a trader, and you can find those in tunnel through the air. And I know some of you are studying that, and people send me emails and ask me questions. That's fine. If you're putting in the work, I'm happy to offer some guidance there. But I'm not, as some people have requested, just going to put all my work up for free on the internet. Life doesn't work that way. You have to put in your own time. You have to invest in yourself and in your knowledge if you want to move forward with this stuff. But then, once you've applied your form reading to those timeframes and you know where you are in your major and your minor cycles, Gann said there's always a major and a minor, and a positive and a negative and a neutral. But once you know where you are, it's time to take smart trades. And that's all that I've done on this Australian dollar trade. I did take the trade. I don't think it's going to be a ripper. Maybe I'm wrong. But I was expecting a little bit of a pullback into today or tomorrow. Thought it might be a little bit more than this. But hey, at the end of the day, I was in there for a couple of hours and then the stop loss is at break even. It doesn't really matter what happens. So in summary, I'm not trying to trade every day or even every week. Form reading is an ongoing process. I will apply it most days. I don't have to be in front of the market every day with form reading. Sometimes you know you're in a trade, it's going to go up for 2 weeks, so you just ride that out for 2 weeks. You're not trying to jump in and out all the time. But I'm not trying to trade all the time. Sometimes the market is a complete mess and you're not going to take any good trades in that time anyway. And the best thing that you can do is take the time off. Go to the beach, spend some time with loved ones, do some research, do some reading. Relax. There's another thing that you can do as well. Probably not my strong point, relaxing, but I'll get there one day. But the point I'm making is you're not trying to do this all the time. You're trying to do it at certain times. And it's funny, this form reading goes hand in hand with your cycle work from tunnel through the air. But so many people go into tunnel through the air without that form reading background and they just get into all sorts of trouble. It's a bit sad actually, but there you go. It's not like Gann didn't warn us. He puts it in just about every book. At the beginning of each year, I already know my cycle dates that I'm watching. For example, the early January, the early February low, I had marked on my market. Now, arguably the best of those dates, which was the 31st of August for a top and a crash, hasn't worked out. But form reading is what keeps me safe. When I first started out in Gann trading 20 years ago, I made a forecast, I jumped in and traded, the market moved against me, and I kept going. I sold some more, and I ended up wiping out about 90%, just under 90% of my account. Okay, because I didn't know how to read the market. I overtraded, and I was like a deer in the headlights, and it was a very unpleasant experience. Form reading, again, is what's going to keep you safe in the market. You read the market, you get in at the best time, you put a stop loss on, and then as soon as you can, you move your stop loss to break even, and then all of the risk is off the table. What actually happened to me was I was trading with a platform where you didn't put your stop loss on automatically when you took the trade. So I clicked myself into the trade, and before I could put the stop loss on, the market had run. It did a little run about 20 points past where I got in. So I was already past my risk tolerance on the trade. And I thought, oh, I'm already going to be stopped out. I'll just wait for it to come back a little bit. And it didn't come back. It just kept going and going and going. And then when you're in that losing mindset and the trade's going against you, you have this thought of, oh, I can get it back. I can get it back. And you start doubling down on the trade thinking, oh, well, if I sold at this price and then I sell at a higher price, it only has to go back half the amount and I can break even, so I'll do that. But you just keep digging a bigger hole for yourself. And you think it can't be done, but it's been done. And I'm sure that there are others watching this video who have stories like that, where you just lose a ridiculous amount of money and you just look back and you just think, what a stupid thing to do. How on earth did I do that? And normally, we're all sane individuals, or most of us. I mean, some of us Gann traders are a bit weird at times, but we're all sane individuals. And you look back and you say, why did I do that? I don't understand. But it's the pressure of the market. And that's why Gann harped on, in addition to form reading, he harped on about having a trading plan, having a stop loss, not over trading, and protecting yourself psychologically. If you have a couple of losing trades, you're going to want to chase the market and try and get them back. Take a little rest from the market, clear your head, and then come back and try and make your money back the next time you've got a cycle date. So if I'm wrong on the market, as it appears I was with this 31 August top that I was looking for on the market, I've had a loss and a small profit on that, so I'm slightly ahead on there, but it was disappointing. But all I do is go back to my cycle dates. I know when the next one is. You can follow the Forex form guide on Sundays on this channel, and I talk about those all the time. I just wait for that next cycle date and I'll form read the market as we approach it, and I will look for smart trades. So I'll look for a small risk on entry, and then I'll look to move my stop to break even, and I'll just follow the same plan over and over and over again. Here's an example of a typical chart. I've got monthly at the top and then weekly off to the side, daily down below, and 4 hours down there. You can see on the daily chart, for example, we have broken above this trend line, sitting on it and pushing up there. Whereas on the monthly chart, we're now approaching a bigger picture trend line as well, and a big 50% point. So this market, which has been pretty much sideways, you can see here on the weekly chart, been sideways all year. This thing is getting ready for a breakout, which again, you can read more about in Gann's form reading lessons. But it's likely going to either break out to the upside or break out to the downside and give us a strong trend either way. And we'll talk more about this. We'll keep following this each week in the Forex form guide on Sunday evenings, 7 p.m. Sydney time. That gets released. Now, just a quick plug, I learned a lot about swing trading and form reading and price forecasting from Safety in the Markets Active Trader Program, and I was part of the team that revamped the Active Trader Program and turned it into the Active Trader Program online training. I'm not associated with Safety in the Market anymore, but I was a student there and I was a teacher there for a time. And it's one of the few Gann courses outside of Gann's original works that I do recommend to any trader who asks me what I think is a good place for them to learn about Gann or to improve their Gann knowledge. There's a lot of good stuff in there, and there's more form reading stuff and swing trading stuff that I haven't put into this video because it's not my intellectual property. I learned it from that active trader program, but I do use it in my trading every day. So if you are looking to expand your horizons in this area, that is a program that I do encourage you to check out and see for yourself. Let's have a look now. You can see the Aussie, again, back here when the market ran down, ran up, and then couldn't repeat 100%. I thought this is a little bit messy. Probably with the big picture uptrend is what's still going on here. The market's not really pulling back all that far, and I could tell that here as part of the form reading. Now, it ran up to the 1/8. It's run down here. It's now mucking around here, but it is looking like it's going to go up and test that 1/8 again. Now, Gann says that the second lower top will be stronger than if it was triple tops all at the same level. So you've got a top, lower top. If you get another lower top on that line, it could be a good place for the market to tank to the downside. And depending on when that happens, let's say you get in right near the top and then the market makes its next lower top down here. What's that top? It's only 10 points away there. Let's say you got in at 66.76 and then 66.66. Well, your average price would be 66.71. Now, if you're selling right on the angle and you could put your stops 5 points away, now you've got a double position and you're at break even on both of them. And I'll let you write that down and work it out for yourself. But let's say whatever position size you trade, say you sold at 6676 and then you sell again that exact same position at 6666. And I'm not trying to give you any numbers of the beast or anything like that. That's just what the price is at the moment. But the average of those sold prices, look, I'll give you another example. Imagine it's a $2 stock. You buy it at $2 and then at $2.20, the same amounts. You buy 100 shares at $2, 100 shares at $2.20. Your average is going to be $2.10. Same scenario here. You average the prices, and let's say that your break even is sitting above there. You can enter or accumulate with the market's money and have a break even trade on. So worst case, you've now got a double position, and if you get stopped out, it's break even. But if you're right and it goes down, you're making money twice as fast there on that market. And it's all possible, but not on every move. And that's what you have to get into your head as a trader. It all works and it's all possible, but you've got to look at the multiple swing chart timeframes. You've got to make your decisions. You've got to pick your areas that are giving you a high probability for a change in trend. Again, honestly, when it comes to price forecasting, there's more to form reading than just price forecasting. But from a price forecasting perspective, there's a lot of really good stuff in that Safety of the Market Active Trader program. And you can use that to pinpoint these exact levels often. Not every time, but often you can get close there. There is actually a higher level above that in Gann trading where Gann uses squaring time and price and his squares and master charts to come up with exact points that the market must go to. And that's evidenced in his 1909 Ticker and Investment Digest article, which you can watch on this channel as well. But it is possible to get in at these precise levels. Now, sometimes you get in at the precise level and the market kicks you out very quickly because there's not a lot of room for the market to breathe there. If you're trading on a bigger picture time frame, like a daily chart or even a 4-hour chart, for example, when you get into the market, it's rare that the market's just going to stop you out and then run off without you. Whereas you're more likely to get false broken out of the market on a small picture time frame like this. So it's not always rosy. But as I said, if you wait for those times where there's a high probability setup and there's lots of signs of completion, you can get in with a small risk on entry, quickly move your stop to break even, maybe add to your position once or twice. I mean, the Aussie is very flat. Normally you'd see it run down further than this, and then you'd be pulling back somewhere down here, or lower down, and these numbers would be further away from the top. So it's easier to compound. This is not a compounding scenario by any stretch of the imagination. So I wouldn't be compounding here at all. But that's the strategy. Small risk entry, move your stop to break even. When you can, add to the position so that your stop loss is at break even or better for your entire position. That's very important as well. And then sit back and let the trade do whatever it wants to do, because ultimately we're not in control of it. Now, I did promise I'd be adding in some additional techniques. Here's another one that is worth considering. Our whole run up here from this low up to the top was 527 bars. On the way down so far, as I'm recording this, or as I took this screenshot here, on the way down, the market has retraced almost 3/8 of the run up. So it's retraced 3/8 in price, but it's only run down 72 bars. Now, previously we ran up 527 4-minute bars. This is just over 1/8 of the previous run up. So we've only retraced for 1/8 of the time, but we've already run 3/8 of the price, or close to 3/8 of the price. So what's going on here is that the price overall is running a little bit faster to the downside here. So as long as we can stay below that 1/8, this market might have some more downside in it. As I said, it's probably due for a pullback. If it's not here, it won't be too much further up. But as the next top is 6776 that I'm looking for. But in the meantime, you just watch the market. It's either going up or it's going down. And you do your form reading and you look for your areas of completion and then you trade accordingly. Here we go. I think this was the last slide that I did before I started recording. We've run up now. We've touched that level for a second time. So we've had our top, lower top again. I'm 50-50 on whether that's going higher or not. At the end of the day, I've got a break even in place. So it's not the end of the world. But we'll see what happens. We might actually jump in live now and have a look at that. As you can see, I had been taken out of the trade for a break even on the position, and the market has promptly come back down there. So there you go. That one got away. As I said, I don't think it's going to be the trade of the year. And if it is the trade of the year, there will be more opportunities on other timeframes for getting back into the market. But there you go. That's the price of checking out a double top. And the price was $0. Didn't cost me anything at all to have a crack at it because I got a break even trade out of it. So there you go. Now I will just have a quick look if I move this angle down a little bit to one of my lower lows there. There you go. That was really, you had that bigger run down there and then this top was broken. Maybe that is your true 1/8 there. Okay. If I was a trader and I was dependent on every point in the market, look, if you're trading a $100,000 position size, you're only looking at $10 a tick. So moving your stop down a few ticks, 6 ticks risk, it's $60. It's not that big a deal if you lose $60 and you make $600. That's a bit better. But once you start trading in the millions, every $1 million position on the Aussie dollar, that's $100 a tick. So if you have a break even at 6672, and then you can pull it down to say 6671, well, it's $100 per million that you're trading there. And it only takes a few points. 5, 10 points, that's $500, $1,000 per million that you're trading. And you can very quickly make money in trading. But on the flip side, you can also very quickly lose money as well. I'll just very quickly move this across to the extreme low there. That's probably an area if you were still in that you'd be watching. But to me, I think this is probably a trade. I've let it go. It wasn't one that I had on my radar. My next date is the 26th of September. Today's the 16th of September. So I'll wait and watch until then. If a great trade arises, fantastic. I'll take it. If not, I'll wait for that 26th of September. It's only 10 days away. Plenty of ways that I can occupy myself between now and then. That's all for this video. I hope that you enjoyed it and that you found some value out of it. If you did find some value and you would like to express some gratitude, all I'm asking for, I know a lot of YouTubers will say, oh, buy me a coffee, make a donation. I'm not doing anything like that. I don't need that. But if you want to help me to get Gann's message out to more people, what you can do that would be a big help to the channel, because I don't normally get a lot of likes and comments, click the like button, leave a comment. If you're really keen to be helpful, like other people's comments as well. Reply to other people's comments if you have something that you'd like to say. Leave a comment, say hi, and subscribe to the channel if you'd like to keep up to date with my future videos. And if you'd like to delve into Gann's cycles, you can find them obviously heavily coded in his novel, The Tunnel Through the Air, and you can find that on the channel. I've recorded that as an audiobook. As you can see, it's on there chapter by chapter, so you can tackle one chapter at a time. It's a hard read, but there are cycles in there that are hidden in plain sight. Let me say that again. There are cycles in there that are hidden in plain sight, and I looked at them for years and years and years, and they just went straight over my head. But if you do the work and you listen to it and you study it and you pay attention, I promise you there is gold in this book. To help you find that gold, there is another video on my channel called Recommended Reading for Gann Researchers. You'll find that at the top of the channel under the New to This Channel, Watch These Videos playlist. And I'm sure by now you're starting to get the sense there's a little bit of work involved on this Gann journey, but boy, is it worth it. Again, that's all for the video. If you do have any questions, you can leave them in the comments, or you can email me, AussieDollarman@gmail.com. And just a reminder, the Forex form guide goes out at 7 p.m. every Sunday night, where we take a look at the major currency pairs through the lens of WD Gann analysis, and we do plenty of form reading there as well. So if you want to keep up to date, subscribe to the channel and you'll get a notification when new videos come out. That's all for this video. I hope that you found value. Wishing you all the best with your trading and on your form reading journey, and bye for now.